think for the last 1 week or 10 days, we received multiple queries on this particular stock. So we thought this week we'll cover this bank. So in today's session, this is what we are going to cover. So of course, Axis Bank is one of the India's leading private sector banks. Here we'll cover the history, business model, recent, performance highlights, and the future growth potential as well. Coming to the history part, so founded in 1994 as UTI Bank. So now it is Axis Bank, but once upon a time it was called UTI Bank. And around in 2007, the bank was renamed as Axis Bank. Why it was called UTI? Because it initially promoted by UTI, Life Insurance Corporation, and other government entities. But it quickly grew into becoming one of the largest private sector banks today. And today it ranks among the top three private banks in India by market share. Private banks, of course, SBI is bigger in the PSU sector, but when it comes to private sector, HDFC, ICICI, Axis Bank, Kotak, so on and so forth. That's the order. Now let's look at the business model of Axis Bank. But before we get into the business model of particular Axis Bank, one thing you need to understand is bank or in general financial companies business model is slightly different than the non-financial banks. For example, if you take a FMCG company or a pharmaceutical company or a IT company, so these are non-financial companies. They have a product or they have a service. For example, FMCG product, there is a soap. The company invest capital in manufacturing facilities like land, building, plant, machinery, equipment. They buy raw material, they convert that raw material into a finished product, they market it, they give it to retailers, then to distributor, then to the end customer. So they sell a product and they receive money, which is sales. And after you deduct all the expenses, whatever is left, that is called profit. Same applies to a service also. They give you a service, take money as sales, deduct all the expenses, whatever they get is profit. But when you look at a bank or a financial institution, that's not the thing. There is no real product here. Bank take your deposits. It can be savings account, it can be current account, it can be FD. So what a typical bank is doing is they are collecting deposits from the customers, but they have to pay interest on that deposit. For saving account 3% or 4%. If they collect FD from you, they have to pay you 6% or 7%. So as you can see, bank has to pay you money for taking your deposits. Have to earn that money or that interest. So they take money for 4%, 5%, 6%. They give it out as loan. It can be home loan, it can be vehicle loan, it can be education loan, whatever, any business related loan. So they generally give it out as loan and they earn 9%, 10%, 12% on that. But they will pay you, the depositor will be paid, let's say 3%, 4%, 6%. Whatever is left, the cost of borrowing minus the cost of whatever they are giving out of debt. That difference is the net interest margin. That is what the bank is earning. So that's the business model. So whatever the deposits that bank is having, it is not an asset. For example, X bank has got 2 lakh crores of deposits. That 2 lakh crore is not an asset. For bank, it's an obligation. It's a liability because eventually they have to give that 2 lakh crores out to the depositors. And they gave, let's say, 1.5 lakh crores as loans for the borrowers. Now that loan, whatever they have given, that is the asset. So you need to understand, for a bank, the balance sheet is slightly different. Whatever you see on the asset side are actually their liabilities. Whatever you see on the liability section are actually their assets. So try to understand that first. Now let's look at the business model for Axis Bank. First is their retail banking. So in the retail banking, they offer personal loans, credit cards, mortgage loans. They provide savings accounts and some investment related products. And they also have got strong digital presence. They have their mobile banking apps like Axis Mobile, or of course they are serving some millions of users on a monthly basis on their app. Next is their corporate banking. So in the corporate side, They provide again loans, cash management, treasury operations, trade finance services to large corporations or SMEs, or even individual business owners. Now the third segment is their digital innovation. So of course they emphasize digital banking through platforms like Neo. So they have a platform called Neo, which is a digital platform mainly for corporate serving corporates and SMEs. And they're also investing heavily on artificial intelligence called Adi. So a Gen AI powered assistant enhancing the productivity and customer service. So basically that is for the customer support. They also have got strong resource and capital base, highly resource profile, healthy resource profile with a substantial low cost CASA deposit base, 45% as of 2025. Now what exactly is this CASA? That is nothing but current accounts to saving account. For example, on savings account, if you deposit, let's say 1 lakh rupees, the bank has to pay you depending upon their accepted rate, maybe 3% or 3.5%. Some banks provide 4%, depending. I mean, it changes from bank to bank. So if it's a savings account, the cost of borrowing for that bank, or the cost of deposit, you can say, is 3 to 4% for saving account. But if it's a current account, generally they don't banks don't pay anything on current account, so zero interest. So the more current accounts that the bank have, it is typically they have got that money for free. They don't need to pay any interest on that, right? So current accounts versus saving account, banks mostly prefer current accounts. Why? Because banks can take their deposits and they don't need to pay anything. Whereas on savings account, 3-4% has to be provided as interest. So the higher this ratio, the higher the current accounts, the better it is for bank, because more current accounts will reduce the overall cost of borrowing for that bank. And with Axis Bank, it is 41%. Solid capital position, ensuring stability with capital adequacy ratio of 17.1%. Now, what exactly is this capital adequacy ratio? For example, let's say I'll give you, there are 100 depositors. 100 depositors, each deposited 1 crore rupees. Let's assume there are 100 depositors, each deposit 1 crore rupees. So bank received 100 crores. Similarly, now just deposits is not going to help the bank. They have to give these deposits out as loan and generate the interest income. So only then the bank can survive. But there is a limit for that on how much the banks can lend. They cannot give out total 100 crores. So RBI's standard percentage is 9%, around 9%. So if 100 crores is taken as deposits, you cannot give out 100 crores as loan. You should at least maintain 9% of that in your surplus, or you have to keep 9% as surplus and give out remaining 91% as loan. For every 100 crores that the bank has, 9 crores they have to keep aside as a provision for safety, as a safety cushion. Only 91 crores they have to give out as loan. So RBI standard capital adequacy ratio is 9%. But what Axis Bank is doing is they are keeping aside 17% of their total deposits. If they receive 100 crores, they are keeping aside 17 crores and only distributing out some 83 crores. Now higher capital adequacy ratio is equal to strong financial health. Why? Because during the times of uncertainty, this surplus amount is going to help the depositors in the bank. And of course it also increases the transparency and investor confidence also. So even if there is any uncertain activity happening in the overall economy, Axis Bank is not going to take a hit brutally, because they have set up, they have a good 17% kept aside. So higher the capital adequacy ratio, the better. Standard practice is 9%, which is set up by RBI, but Axis is maintaining some 17%. Next is market presence. So we have already discussed like Axis Bank is the third biggest bank in India. I mean private sector bank in terms of market share. So they have got around 5,800 branches across India, and of course they are also serving. They have got international presence, serving in Indian corporates abroad and facilitating global trade. So as you can see, third biggest branch, third biggest bank when it comes to market share in the private sector banks. Recent challenges. Now, when I say recent challenges, these are not just Axis Bank challenges, general industry challenges recently. So, economic uncertainties affected overall banking profitability due to reduced corporate advertising and cautious lending. So, regarding the corporate advertising, I think we have already discussed this last week also during TV Today network, presentation. So, what's happening is whenever, for example, you take vehicle loan as an example, when the overall economy is not performing well, generally the sales of the vehicles also go down. So, be it two wheeler, be it three wheeler, four wheeler, trucks or tractors, whatever it is, these companies has to spend money on advertisements. They spend heavily on advertising. They promote their products, which is vehicles, and they attract the customers. But even today, like more than 80-90% of vehicles are bought through financing. That is vehicle loans, be it two wheeler or three wheeler or four wheeler. Most of the vehicles are bought on EMIs. So if the general overall economic condition itself is bad and the sales are going down, obviously banking industry will also take a hit. And the same applies to even housing finance also. uh, if home loan as a product, if you kind of take out that product, more than 90% or 95% of citizens in our country cannot afford to buy their own house. So to buy a house, they need home loan. So during economic uncertainty, when people don't have enough cash, the home loan segment will also take a hit. The auto segment, that is vehicle loan, also take a hit. And of course, cautious lending also prevails during that point in time. So that's what happening. Overall slowdown in the economy. That is one challenge. The other is increased competition in the banking and fintech sectors exerted pressure on the margin. So, of course, when the business slows down, generally the rivalry among the industry peers goes up. Strategic growth strategies and the outlook. Of course, they want to expand their digital banking offerings, digital customer engagement. That is the reason they have that Gen AI powered Adi for customer support and all. They want to grow SME and mid corporate level lending with targeted services and customized financial solutions. So basically, they want to grow their deposit base. That's what every bank want. So SMEs through mid corporate, I mean, want to open new branches in the tier 2, tier 3, even in the rural areas. So they want more deposits and more digital presence. And the risk to watch. So economic cycles affecting asset quality and loan repayments. If there is any recession, slowdown in the economy, generally the asset quality goes down. I mean, companies lay off employees during slowdowns or recessions, and they may not be able to pay the EMIs on time. So the loans becomes NPAs. So it's a cycle. Regulatory risk and compliance cost. Regulatory risk is the most important. Like if RBI comes up tomorrow and change some rule, of course the profitability will take a hit. Competitive pressures, both from the conventional banks and of course the fintech startups also. Now this is what most people are eagerly waiting to know, like recent quarterly results where the net interest margin or the financing margin for Axis Bank dropped significantly, and people were asking me questions regarding that. So operating profit actually increased by 14% year on year, by 7% quarter on quarter. Of course, I'll show it in detail. First, you look at this slide. So operating profit actually increased, not decreased. Net interest income grew marginally by 1% if you look at year on year, but declined by 2% if you look at quarter on quarter. And I'll give you the reason why it declined. Now comes the net interest margin. This is what I said. Cost of borrowing versus cost of lending. For example, the cost of borrowing is 5%. Cost of lending is 9%. What is the difference? 4%. That 4% is the profit made by the bank. The difference between the cost of borrowing. So here that the difference is 3.8%. Fell to 3.8%, down by 17 basis points. Meaning previously it was 3.97, 0.17% drop. So previously it was 3.97%, now it is at 3.8% compared to the previous quarter. Non-interest income, which is like other income you can say, increased significantly by 25% year on year, driven by primarily higher fee income. So their fee income alone grew by 10% year on year. Retail fee increased by 9%. Then comes the overall loan growth, which is 8% year on year. Loan growth is very important for a bank more than the deposit growth. Why? Because banks are taking a lot of deposits, but if they are not able to distribute that amount as loans, it's an additional burden for the bank, because bank has to pay that 4% on savings account, 6% on FD. So loan growth is very important. So here the loan growth is 8%, which is good. Next is asset quality. Last week someone asked me like what is gross NPA, what is net NPA and all. So gross NPA stood at 1.57%, net NPA stood at 0.45, slightly higher due to the technical adjustments. I'll cover the technical adjustments also. Now what exactly is NPA? You might have heard of NPA when it comes to banks, which is nothing but non-performing assets. Now what exactly is this non-performing assets? For example, any loan, it can be vehicle loan, it can be car loan, it can be home loan, any loan. If the customer or if the borrower is not paying the EMI or not paying the principal amount for more than 3 months, 90 days, they call it as non-performing asset, which is NPA. NPA is nothing but non-performing assets. Non-performing for more than 90 days or 3 months. Then what is the difference? What is gross NPA? What is net NPA? For example, I have given you an example. A bank gave out loan of 1 crore rupees each for 100 people. Okay. Bank gave a loan 100 crores. Not 100 crores. Okay. Let's say bank got 100 crores as deposits. Now what is that capital adequacy ratio? Let's say they kept it as 10%. So instead of distributing this 900 crores, they kept 10 crores with them. They only distributed 90 crores. But whatever the 90 crores they have distributed, among 90 people, let's say they have distributed, 5 people are not paying, are not able to make the EMI payments and defaulted for more than 3 months. So out of that 90 people, you can call 5 people as NPA. So 90 crores is total amount that is distributed as loans. In that 90 crores, 5 crores is termed as NPA because 5 people didn't pay. That is gross NPA. Total non-performing assets is 5 crores. But generally what banks do is, like I already mentioned, banks will not give out everything that they have. They will keep aside some amount as provisions and they distribute the remaining. So here in this example, gross NPA is 5 crores. But let's say for that, let's say the provision is, let's say, 2 crores they have kept aside. You deduct that provision, it becomes 3 crores. So 3 crores is net NPA after taking out the provisions, whatever they have kept aside. So gross is the total NPA, net is after deducting the provisions that they have already considered. So that is the reason you can see on total loans that they have distributed, 1.57% of their total distributed loans are considered as NPA. But net NPA is only 0.4 because remaining 1.1% or something like that, they have already kept aside as provision. So their actual NPA is only 0.445. If you look at their historical numbers, how it performed, of course, money control is not providing the numbers for consolidated. But anyway, let's look at. I just want you to understand the trend. Don't place too much emphasis on the exact number. Just focus on the trend because this is standalone, not consolidated. So as you can see, from 3.7 to 2.8 to 2.2, 1.5, 1.28. And you will see the same trend with the net NPS also. So if you look at the asset quality, Axis Bank improved its asset quality significantly over the past 4-5 years from 3.7 to 1.28. That is, but if you look at, if you consider it as consolidated, maybe it is something like 4% to 1.5%, which is a significant improvement when it comes to asset quality. Next is capital position. Again, this is quarterly. So in the current quarter, their capital adequacy ratio is still at 16.85. I'm sorry, is still at 16.85%. 9% is required. They are maintaining some 16-17% capital adequacy. So obviously great. Now comes the most important question. So this is the question. As you can see, sales are more or less intact. So 112.87 to 112 to 127 to 128. Only one quarter, passed from here. So there is still some growth. And financing profit is positive. Other income, you can see there is significant growth in the other income. And for a bank, other income is fine because they have some financial products and all. So as you can see, other normal income, which is quite normal for a bank. So don't look at a bank the way you look at an IT company or a pharmaceutical company. Bank is completely different. So as you can see, even net profit is also 28,000 crores. 28,000 crores, more or less close to the recent March 2025 numbers. So the actual numbers didn't fall the way everyone is, panicking, like why the margins have gone down. And if you closely observe, this is what you can see. From 2017 to 2021, the financing margins were actually negative. But you can see the overall net profit was positive. So what happened? So this is the recent quarterly statement for Axis Bank. So you can see here, this is the interest earned. Now for the quarter ended 2025 March, you can ignore these numbers. Let's focus on these numbers. Let's do year on year comparison. This is quarter ended June 2024. This is June 2025, which is the current year. So let's compare current June with the last year June. 32, here it is 31. So as you can see, interest, whatever the interest income, that is increased. As you can see, 24, 25. Investments 5,600, 6,100, 300, 307. Other income also 6,600, 8,500, 8,052. Total income you can see 37,000, 40,000. So you can see every number improved. So far we don't see any issue. Next, employee cost slightly increased. Other operating incomes is actually more or less close. 6295, 6296. Operating profit you can see one at 10744 it is, here 12213. So as you can see, operating profit also increased. But this is what happened. Now you see from 8600, the actual profit reduced to just 8179. Why is that so? Everything else we can see improved significantly, but when it comes to the bottom line, you can see their net profits dropped from the previous quarter. Profit before tax also dropped. What is the reason? The reason is provisions. As you can see, last year, June quarter, the provisions and contingencies were only 2100. This year, they increased that provision to 4034. Got it? I'll explain what is the provision and all. So, this is where the profitability got impacted. The net interest margin and all got impacted because of the provisions. For why the margins have dropped, there are two reasons. Reason number one, RBI rate cut impact. So the Reserve Bank of India recently reduced interest rates by 100 basis points. One second, guys. So what exactly is that 100 basis points? That is 1%. This rate cut resulted in Axis Bank reducing its lending rate, causing margins to decline since loan rates adjusted quicker compared to the deposit rates. So the over, let me explain the situation. RBI rates were cut, repo rate they call it, right? So interest rates dropped by 100 basis points, which is 1%. Fine. But there are two types of loans when it comes to any loan. You can take personal loan, you can take car loan, home loan. There are two types of loan. One is floating rate loans. The other is fixed rate loan. Now, when you take a floating rate loan, the changes of the interest rates will impact the EMI. If the interest rate goes up, the EMI will go up. If the interest rates comes down, the EMI comes down. As you can see, the floating rate EMI's impact is immediate. Fixed rate, I mean, there is no change because of the interest rates, but since it is fixed, whenever you are taking a loan at that point of time, if you have agreed for 6% or 9% or 12%, that will stay fixed forever. But with floating rate, it keeps on changing, right? So floating rate EMI will drop by 1%, which is a direct hit for the profitability on the bank's profitability. How they can balance it? They can reduce what they are giving out as interest on their savings account, on their FDs. But the issue is the EMI is immediate. EMIs are getting immediately affected, but they are not able to reduce the rate on the savings account or the interest rate on the FD immediately. They cannot do that, so they'll do it in a slow manner so that there can be a smooth transition. Because if they reduce FD rate from 6% to 5%, people may stop doing FDs and they might invest somewhere else, so the liquidity will get disturbed. So that is the reason they'll do it slowly. So that is one reason why the margins have dropped. Only 25 basis points, that is 0.25 out of that 1% interest that is decreased, only 0.25% is fully reflected in this quarter. The remaining 0.75% will impact margins fully in the next quarter. So you will see a bigger drop in the margins, not just overall margins. This effect of interest rate change, you will see a bigger impact, which is 3x more impact in the next quarter. Why? Because in this quarter only 0.25 or 25 basis points are reflected. Remaining 0.75 or 75 basis points will be impacted. The margin will show you the impact in the next quarter, further pressuring the net interest margin. So be ready for that. That is one drop in the interest rates. Second is more important because this rate cuts or rate interest rate is cyclical. It comes down, it goes up. So which is cyclical. You don't need to worry about the interest rates. It goes up, goes down. That is pretty natural. The second is the technical adjustment. That 2000 crores, 2100 crores as provisions, they increase that amount to 4000 crores. Now that is most important. That is the actual reason why the margins have dropped. Now what happened here? Axis Bank adopted a more stringent accounting policy for recognizing bad loans, which is NPA, leading to higher slippages and credit cost. These adjustments involved a more conservative approach to classify certain loans as NPAs earlier, leading to higher provisions and interest reversals, which directly reduced profitability and margins. Total additional provision due to this change was 821 crores, reducing the net profit by 614 crores for the quarter. Now let me explain this. So generally, I've already mentioned this in the beginning of the presentation. There is a standard practice in the industry or standard process, let's say capital adequacy ratio. Let's say it is 9%. RBI is saying for every 100 crores of deposit you receive, you keep at least 9 crores aside, 9% aside. With the remaining amount, you can do the business, you can give it out as loan. But for stability purpose, for financial stability or financial health, the companies can decide, okay, we'll maintain 12%, we'll maintain 15%, or we'll maintain 17, 18%. So Axis is maintaining 16, 17%, right? For more financial stability, less risk, more conservative nature. That is what the technical adjustment is here. So Axis Bank is adopting stringent accounting policy for recognizing bad loans, which may eventually lead to higher slippages and credit cost. So, for example, the industry standard is if someone is not paying the EMI or the principal amount for more than 3 months, that is 90 days, you consider it as NPA. That is the industry standard. But and why they are maintaining that industry standard? So that there are less slippages, there are less credit costs. That is the reason. But what Axis Bank is doing is they are not even considering the industry standard. We are not even considering 90 days. We are following a policy where we might consider some account as NPA even before 90 days policy. That is even before 90 days if we have enough proof, or being more conservative. They are not waiting for 90 days. If they identify, they might have some their own patterns for identifying that. So if they consider something as bad loan, they are going to turn that account as NPA even before 90 days. To do that, they have to maintain more provisions. But why they are doing it? More financial stability, more strength during the uncertainty. And these adjustment involved more conservative approach to classify certain loans as NPIs earlier. Earlier than what? Earlier than 90 days. Industry practice is 90 days NPA. But Axis Bank is saying, no, we will do it earlier. So, which is leading them to have higher provisions. From 2000 crores to 4000 crores. Now they have to maintain higher provisions, which directly reduce the profitability and margins. I think somewhere in the management analysis or management quality, I generally mention this. I like managements who take decisions which might hurt their P&L in the short term, but it should help them in the long term. So that's a long term focused management will think. That is what Axis Bank is also doing. If they do this, they know that the current P&L will take a hit. But what they are doing is they are making this decision so that the depositors, they are being conservative so that their depositors can have some safety cushion. They can maintain overall transferability, that they can be transparent, and overall investor confidence. As an investor, I can also feel confident that even something goes wrong, Axis Bank will not take a big hit because they have got bigger provisions. So they are maintaining that stringent accounting policies. So they are not being aggressive, they are being very conservative. They are cutting 614 crores of reported profits and keeping it as provision. So this is what the total additional provisions due to this change is 821 crores. Industry standard RBI expected is, let's say, X. Axis Bank, what Axis Bank is doing is they are maintaining X plus 821 crores. So that 821 is not required. Even if Axis Bank doesn't maintain that 821, no one is going to question them. But what Axis Bank is saying, no, we will maintain the industry requirement. Addition to that, we will maintain 821. Why? So that the depositors, the investors, everyone can feel safe. And in the process, what they have done is their reported profit reduced by 614 crores. But this is reported profit, this is not actual loss. Just because they are maintaining something for provision doesn't mean it's a loss. It is surplus amount kept aside. So it is not real loss. So it is not real drop. It is technical adjustment due to higher provisions. So Axis Bank, if you want to see whether Axis Bank is has grown or is not growing, for that the one thing that you can check is this: the total operating profit. As you can see, 10,744 to 12,213. There is actual growth. But when you go and check in the bottom line, you are not seeing that growth. The reason is pretty simple. You add 641 crores here, then the net profits will be somewhere close to 7,000 crores. So 6,400 to some 7,000 crores. So there is actual growth. So the company chose to report it in that provision. It is not real loss. It is not real margin drop. It is just a provision. It is Axis Bank choice to maintain that provision, and due to that, the investor confidence will increase. The safety for the depositors will go up. So overall, it's not a bad news. It may be or may not be a good news, but it's not a bad news. It's not a red flag. So people were worried. That's why I'm saying this. Now, what is the future outlook on margins? Not technical adjustment related, the interest rate related margins. So management expect margins to stabilize and recover gradually after a short term impact, stating a sustainable long term net interest margin target of around 3.8 through the full economic cycle. So what is the current number? The current number is close to 3.8. They believe the current margin compression is temporary, largely due to rapid interest rate cuts and the conservative accounting adjustments this quarter. This quarter is the keyword here. They are not going to, increase the margins every quarter. This year they have adjusted. Maybe next quarter, their provisions might be lower because they have already shown a bigger provision here, right? So don't expect like every quarter they'll show bigger and bigger provisions. No, they did some conservative thing in this quarter for future purpose, for long term stability. So again, this is a temporary thing. As deposits reprice, what reprice? The interest on your savings account and the FD will go down. So once that deposit reprice happens and the economy stabilizes, margins are likely to improve. So one simple thing, interest rates dropped. So their income on loans dropped. but their cash outflow is interest paid on deposits and FDs. That is not going down immediately, so they are slowly cutting down the cost. So once that repricing happens, and that full price is captured, then the margins will automatically improve. And of course, overall economic stability and all will take, uh, anyway, the net interest margins they are expecting is 3.8. So I hope you got your questions answered. And coming to the valuation part, so by the way, this is what it looks like. So some years cash flows are negative. Again, it's a bank. Uh, don't look at the cash flows of a bank, because it is reverse. Cash inflow and cash outflow is completely differs, because they get your deposits, cash is coming in, but they are giving out that cash as loan, cash is going out. So cash going out is actually an asset for them, not a liability. So for a bank, cash should go out. And return on equity also, like, a lot of leverage is involved in a bank. So even return on equity also comes slightly, fluctuates. But a long term average of 10 to 12 is something that I look for. Growth is very good, and debt to equity will be higher for a bank. So if it's a bank, then all these numbers are slightly different. Current P is 12, which is reasonable. So relative valuation, you can see earnings yield is very good, 8.21. Cash return, again cash flow based, so ignore that. Even price to earnings is also lower than its long term average. Price to sales or price to book is more important for a bank. So even price to book ratio is also less than its long term average, is close to 2. So current 1.81. So overall relative valuation says it is underpriced. Again, DCF and all doesn't, here it is positive, but don't consider cash flows, because cash flow based valuations doesn't work for financial stocks. So what we consider is only these two valuations, which is earnings based valuations. So based on that earnings based valuation, the intrinsic value is somewhere around 1367. Current price is 1095, and phase one, that is MBP, 1231. 1000 or 1100 is lower than 1231. So yes, Axis is still in the buying zone, and Axis